I want to say that questions and answers are welcome. Welcome anytime during the chat, but we will also have a session near the end of the presentation for anything that didn't get caught along the way. So feel free to be interactive. We're here to serve you guys. I'd like you to imagine yourself as an imaginary buyer. Doesn't matter whether you're male or female, but try to put yourself in the position of this person. This person we're referring to as Mrs. Pepper. She owns a medical online sales and service business with $5 million in EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a big, long word for profit. She's been trading hours for dollars at the helm of the company, but it's becoming a little monotonous. She's considering or wanting to begin considering the exit process for her business, but like I was a little concerned about my ability to maintain lifestyle and continue to produce monthly income on a passive basis. In this instance, her husband works part-time from home and helps care for their two middle-aged children. So you guys, Ms. Pepper is in essence on a quest. She's in the point where she's an entrepreneur now, but she'd like to get to the point where she can rely on passive income and experience a life that is worth documenting every second of on Instagram. And I threw that in for my wife. But she doesn't know where to start, and she's afraid of losing control of her financial future if she doesn't make the right investment choices. She's made money in the stock market, as have I, but the thought of a large drawdown at the offset is troubling to her. So let's begin with an understanding of sale-leaseback transactions in general. We'll start by saying they can apply to any kind of property. So they can apply to office, they can apply to industrial, they can apply to healthcare, specialty, retail, hospitality. How are they used? So in the real estate market, they're used in a number of ways. They're used to raise capital. They're used as a method of debt reduction, especially what is referred to as on balance sheet. You don't need to worry about that concept right now. And they use the proceeds from their sale-leaseback to reinvest in their core business. And it's also a method for fast-growing companies, which the two examples are that we'll be showing you are, of their ability to access growth capital to help them invest in the business where they think their returns are their highest. There are strategic advantages both to buyers and to sellers, and we're going to go through them one at a time, starting with the buyer. So if we were to look through the lens from the buyer's perspective, what does the buyer see? There's unique benefits for buyers. And when I say buyer, I'm going to say buyer/investor. So you may hear me jump back and forth between the two from time to time. The first top benefit is stable cash flow. The second is oftentimes these come with very long-term leases, especially at inception. And typically based on lease structure, they have lower maintenance requirements, which leads for the investor buyer lower responsibilities and stress. In today's market, sale-leasebacks are preferred transactions. They're harder to source, and they're preferred by many investors. As with all returns, nothing is without risk. So we want to talk a little bit about the things to be cautioned by as a buyer or investor. Tenant creditworthiness is incredibly important. So more than any other transaction, we do a more rigorous underwriting on the tenant side, especially with respect to what is known as the lease guarantor. The quality of the lease terms, especially if it's a long-term lease, have a significant impact on the valuation of the property. So that's something to also be very concerned about and watch out for. As I referred to earlier, there's a deeper due diligence dive that we do on these deals. And frankly, there's a lot that we we get a certain amount down the road and decide it doesn't pass muster. But this is more of an investment banking style due diligence than it is a real estate style due diligence. Now, from the seller's perspective, it's a little bit different. They also have unique benefits, and here I'm going to refer to the seller and the tenant synonymously. One thing that they get to do is they get to unlock equity capital, and we're going to walk through exactly how that happens here in a moment. They do that so they can reinvest in their daily operations without disrupting them. As you can imagine, this is not a company we represent, but it would be extremely difficult to lift all this stuff up off the floor and move it to another location quickly. So what they're doing is, in essence, they're converting a more illiquid asset into a more liquid asset. And then they use this to reinvest in various ways back into the core business. Sometimes they use it for research and development initiatives that they think have outsized performance return opportunities. Sometimes they do it to raise funds to invest in mergers and acquisitions because they believe that the synergistic effect of the combination will be a better return for their investment capital. Other times, they're just trying to improve the appearance of their balance sheet. Sometimes it's just in general. Other times, it's so that they can access additional capital through commercial lending outside of collateralized lending. Now, I don't like to use big words, so when I say collateralized lending, I just mean lending secured by something tangible. The other thing is, if you have a property and it's already paid off, yes, you're still getting tax deductions for property tax and other operating expenses, but one of your big ones is your mortgage interest deduction, and that would be gone at that point. And so for those folks that have already paid down their debt or paid it off, the lease payments are tax deductible. So you never make money giving $1 to Uncle Sam or giving $1 away to the economy and getting 40 cents back from Uncle Sam. But nonetheless, there are tax advantages on the seller/tenant side for entering into these transactions. The other thing it allows the seller and the tenant to do is maintain operational control. If you could consider that, say, as an alternative, they went to private equity, they would be giving up some amount of voting and operational control of their business. So this allows them to stay firmly in the pilot seat, which allows for stability and continuity in the business as opposed to disruption. I'm not going to say that the liquidity is as immediate as the car on the left. I am an aficionado, but I will say that it's faster than traditional lending, especially non-asset backed lending. So it gives them faster access to capital as well, which, if reinvested properly, can dramatically change the growth trajectory of a company. So let's go through, it's only a few slides long. This is probably the hardest part, but I'm going to make it really simple. So financial statement impact. I intended to put 000 at the top, so please just add 3 zeros to all of these numbers. This balance sheet just so happens to be Apple Computer, but it wasn't chosen for any particular reason other than I liked the layout. So in this instance, we're going to say that Apple has a $40 million property. Remember, add 3 zeros, with $20 million in mortgage debt and $10 million in accumulated past depreciation. When they sell and do the sale-leaseback, they're going to increase their cash position by $20 million. Why? It's the property value of $40 million minus the mortgage debt of $20 million. This then carries down to the total balance in current assets. Then property and equipment can be reflected as a gross number with accumulated depreciation separately, and then the two of those form the net. In this instance, it's just one line item. So what this is the property minus the accumulated depreciation. So this would be 30,000 or 30 million rather net property value that comes off the balance sheet. That then rolls into total non-current assets, and the sum total of the two flows into total assets. On the liability side, they had a $20,000 or $20 million mortgage debt, that was reduced from 98 million to 78 million, which then rolls into total non-current liabilities and then into total liabilities. Equity goes up by $10 million because assets and liabilities went up and down by a net $10 million difference. And that then flows through to shareholders' equity and to total shareholders' equity and liability. I know it's a lot of numbers. It's really not much, but I wanted you guys to see how it works on the financial statement. Okay, why is it important? So let's think of what's known as the current ratio. It's an indicator of company health based on the current profit or the current assets and liabilities of the company. So it's kind of an indicator of the ability of the company to meet its ongoing short-term obligations. Current assets went from 143 to 163, but current liabilities stayed the same. And the current ratio is just one divided by the other. So it went from 1.36 to 1.55. It's only a 0.19 lift, but it's a 14% improvement, which is pretty material. Then if you think like an investment banker and you say, what's the funded debt or the long-term debt to EBITDA ratio? A lot of times the unsecured debt that's on balance sheet, the debt that's not collateralized by property, will have some sort of EBITDA limitation to it. So let's say that this particular company had 20 million in EBITDA. It had long-term debt of 98 million. Remember, we paid off 20 million. So the EBITDA stays the same and it goes from 4.9 to 3.9. It's only a one-time improvement, but that's about 20%. And you go, okay, I get it. A couple ratios changed. You're really impressive. Where the growth trajectory of the company changes is they raised 20 million in liquidity by virtue of the sales-leaseback. But let's assume that they had a limit of 5 times on their long-term debt to EBITDA ratio. If they were at 4.9 before, they basically were out of borrowing capacity. But at 3.9 now, they have another 1 turn of EBITDA or $20 million to invest. So that's a total of $40 million that they would have to invest in the core business. Things to watch out for. Everything is not a bed of roses for the seller and the tenant either. They need to make sure that their lease terms reflect the current market. Now, they're long-term leases, so the best they can do is get them as close as they can to the market when they initiate the lease term. They also want to sell for a cap rate that is lower than, and I have here written the weighted average cost of capital. That's just an accounting term for, call it average borrowing cost. It's probably an easier word to use. My apologies for not substituting that. They also want to sell for a cap rate that is lower than their expected reinvested returns on investment. That's a mouthful. We all know ROI, return on investment. You put in money, you get money back. There is no such thing as ROI, but in a sale-leaseback, in essence, they're reinvesting in order to achieve the return on investment. They're also locked in. You know, as you saw with all the manufacturing equipment secured to the floor, it's difficult to just break a lease, move all the equipment, and not subject yourself to both legal battles and transitionary pain in the business, especially if you have a backlog of orders. So now we've built through how buyers look at it, pros and cons, how sellers look at it. We've built through showing you how to translate that knowledge through financial statement analysis. Now we're going to get into understanding the sale-leaseback transaction structure itself. So what we've done is we've built up a set of layers for you guys to understand them kind of one step at a time. So let's put all the chess pieces on the board. We have an operating business. We have a seller, LLC, that owns the property. And we have a buyer, LLC, that wants to buy the property and become the landlord. It's a 2-step process. And the first step is selling your property. So if you notice, the only thing that's changed is the word sale now appears on the left-hand side of the screen. That's what we're going to go over first. So everybody signs a purchase and sale agreement. Everybody executes a deed. The purchase price is transmitted through escrow from the buyer's LLC to the seller's LLC, typically. And then the property is transferred from the seller tenant to the buyer landlord. So as I said before, there's 2 steps to a sale-leaseback. Sale, we've covered. Now let's get into the leaseback. So step 2 is leasing the property back. You'll notice on the right, we now have added the word leaseback and in parentheses lease, whereas we had sale on the left. And this part of the transaction is going to appear in the middle. So it doesn't have to be an absolute net lease, but many times it is. So the parties will execute a lease between buyer and seller, or tenant and landlord. And then the landlord will begin to collect rent from the tenant. So I'll just leave that on there for a second. But that is the basic outline of a sale-leaseback. And then if you've got questions, Tony, that pop up, just let me know because I won't see them. We've gone through pros and cons for the buyer, pros and cons for the seller. We've analyzed financial statements. We've understood the basic transaction structure. Let's talk a little bit about lease types. There's gross, modified gross, net, double net, triple net. You'll hear it as absolute net, absolute triple net. Different people refer to them different ways. We're going to start out with a gross lease. You could also refer to this as a full service lease. Hey, I'm willing to rent your space. I don't want to fuss with anything. I just want to pay one number and not have to think about anything. They're still going to have to provide utilities and what have you, oftentimes to the inside of the suite or of the space, but the rent is grossed up to account for all the maintenance and operating costs of the property. So as you can imagine, over time, inflation hasn't been very friendly to the dollar. So this is not a very inflation-friendly structure, often not seen in sale-leasebacks.
Patrick, we got a question from the audience.
Sure.
I see it from Christopher. Chris, I appreciate your question. It says, so the seller does this to free up capital?
Yeah, it's a capital raising transaction. So they've got equity tied up in their balance sheet, and they either have on-balance sheet debt or they have no debt. And the reason they enter into the transaction, let's say that they executed a 6 or an 8 cap. They believe when they reinvest in their company's growth operations and this combined synergies, that it's going to be greater. That's the reason that they enter into this, and it's fast. Does that answer the question?
Yeah, I think that's a good answer, Patrick.
Okay, so remember, gross lease is like flying in this plane, and then modified gross, you may be responsible for not CAM, which is common area maintenance, which is corridors, elevators, stuff outside the building, but you can become exposed in a modified gross lease to the escalations. You'll often pick up janitorial services inside your own leased space, and you may pick up, depending on the lease, a percentage of building insurance escalations. I would analogize that to flying in this plane as a landlord. A net lease, what you're primarily doing is passing the property taxes over to the tenant. And as you can imagine, if wages go up for janitorial and property taxes go up, these become more and more landlord friendly over time with inflation. I would equate that. This is called the Cirrus Jet. I think it's pretty cool. Next, we have a double net lease. Here you're picking up a percentage of or potentially all of the building insurance. I would call that flying in this jet right here. Looks like a citation. Triple net. So now you've got building insurance for the building itself, and you've got exterior building maintenance, HVAC system maintenance, landscaping and parking lot maintenance, and then oftentimes it's roof repairs as opposed to roof replacements. I would call that flying in this jet. The granddaddy of them all, absolute net or absolute triple net, even the parking lots and roofing structural repairs are included. So this is the most landlord friendly, And if any of us could imagine, it's like flying in this plane.